These are still only down 5% or less since Jan 1. Let's bring in Steve Sosnick. He's the chief strategist at Interactive Brokers here on set with me. I mean, maybe forget it now that we've seen the 2-year and everything go. But what did the market internals tell you?
The market internals tell me that we still have this underlying bid. There's still this undercurrent of FOMO. There's still nobody who wants to miss a rally. And as a result, partially because, as Jeff Curry said earlier, that oil is not as bad as could be. We're not at the depths that we thought we might be. This has been the Persian Gulf situation is something that we've been modeling out. Risk managers, and I was one for a long time, we're always gaming out what would happen if there was a closure of the Strait of Hormuz, and the gaming was $150 to $200 barrel oil and a minimum 10% correction in the S&P 500. Well, we haven't gotten those, and to that extent, maybe because oil's not as bad as it could be, at least not yet, according to him, or maybe it's just because we've gotten so convinced that every dip is a buying opportunity, and every presidential move can be undone, shall we say. That nobody wants to be the one who wants, who's selling it out. And that's the dynamic.
Where do you see people kind of most excited to jump in and across kind of the markets broadly? Is it the favorite names we've talked about over the years? Is it sectors like software? I mean, where do you see activity? I hear more than ever about some of the new drone and AI defense companies and things like that.
There's always going to be a group of people looking for, sort of the sexy new company. And yeah, there was the drone company that went up, 11-fold in 2 days. That's a cool story. Where we see most of the activity, we still see people aggressively dip buying. Micron was the most active stock on our platform.
Wow, interesting.
Why? Because Micron
been such a great performer and had that pullback.
But exactly, it got the crap kicked out of it after earnings, and so people rushed in. One name that we do see a lot of people buying is VOO, which tells me that investors are active, that people are seeing this as a longer-term possibility.
And VOO is just the broad market. It's Vanguard S&P 500?
It is, but what happens, when SPY is active, that tells me traders are trading it, because SPY is more of a trading name. VOO is not as liquid. It doesn't have liquid options at all, but it's cheaper. So investors like VOO, traders like SPY.
And so you think this is a moment, and again, we were saying the worst month in about a year. Well, what happened a year ago? Look at the panic after the tariffs that the president put on. And again, look at what happened if you weren't coming in to buy at that moment. And I guess that's what people are conditioned to do here.
That's exactly it. People are conditioned to see every dip as a buying opportunity. What's the proverb? If you're a hammer, everything looks like a nail. And, to some extent, that was the case. And I wrote earlier this week about the Trump put. And on Friday, I wrote, what's the strike price on the Trump put? Yesterday, we learned that the strike price was either 6,500 on the S&P 500 or 445 on the 10-year. And I actually think it was more of a bond. It was almost more of a bond reaction because as a real estate guy who hangs around with other real estate guys, you're very tied into the borrowing costs. But as a result, I think that's why you saw the president say what he said both Friday afternoon and again yesterday morning, sort of to put in that level. But what happens here is this is a lot harder to undo than the tariffs. The tariffs were the stroke of a pen, and you could change them. In this case, you're dealing with global supplies of a commodity that take a long time to ship around the world and to get those price pressures through. And it's not just crude oil. It's liquefied natural gas. It's fertilizer. It's helium, which did you know?
Right.
I didn't know until this.
Pharmaceuticals.
I had no idea that helium was so critical to semiconductor production. So there's all these factors of the supply chain that need to be worked through. So even if this thing resolves tonight, there's still going to be supply shock effects. Question is, if it ends quickly, you can call it transitory. And I know that's a dirty word when it comes to inflation, but you could think of it as transitory. The longer it lasts, the worse this becomes because they get more embedded in the system.
Quick last question then for the retail buyers. Are they going to be caught off sides if there is a longer lasting impact to energy and a more of a problem for the market in some fashion? There
is a real risk to it. And one of the basic things that I ask people is if you can't price safe assets like 2-year notes, as Rick Santelli just said, how are you expected to price riskier assets like stocks that base their prices on those shorter term assets?